Hello, everyone, and welcome back to the Commodities Institute podcast. I'm Emily Costa. Today is December 19th, 2025, and as we move closer to the end of the year, the commodities markets are doing something they often do at moments like this, revealing the imbalances that have been quietly building beneath the surface. I want to start today not with oil, as tempting as that is, but with gold, because it tells us something important about how investors are feeling right now. Goldman Sachs has put out a forecast that certainly turned heads this week, projecting gold prices climbing toward $4,900 per ounce by December of next year. That's not just a casual call. It reflects a belief that central banks will remain aggressive buyers, that interest rate cuts in the United States will offer cyclical support, and that diversification into hard assets is broadening beyond institutions and into private capital. Gold has always been a mirror for uncertainty, and when forecasts stretch this far upward, it suggests that faith in paper stability is still fragile. What's interesting is that this bullishness on gold exists alongside far more pessimistic outlooks for energy, especially oil. That contrast is telling. It's not optimism driving gold higher, but caution. Now let's pivot to oil because the physical market is flashing some very loud warning signs. West African crude is struggling to find buyers in a way we don't often see. Nigerian and Angolan cargoes for December and January are still sitting unsold, with estimates earlier this week putting the overhang as high as 40 million barrels. To put that in context, West African crude usually trades closer to 2 months ahead. This backlog tells us demand is not keeping up, and cheaper alternatives are winning the competition. Brent crude slipping below $60 per barrel this week wasn't just a futures market move. It was a response to physical reality. Supplies from the Middle East are undercutting West African grades thanks to shorter shipping routes and more competitive official selling prices. India continues to absorb large volumes of Russian crude despite sanctions, while China has shifted toward nearer or cheaper options. Even Nigeria's own Dangote refinery, which had been absorbing domestic supply, is heading into maintenance, leaving more barrels searching for homes. This surplus theme doesn't stop in West Africa. In Venezuela, the oil story is more geopolitical, but no less strained. Caracas has authorized 2 very large crude carriers to depart for China, each carrying nearly 2 million barrels, even as the United States tightens its enforcement posture. These vessels are unsanctioned, but they operate in the grey zone of what's known as the shadow fleet, often switching off tracking systems to avoid scrutiny. What we're seeing here is not just oil trade, but oil diplomacy under pressure. Venezuela's exports have fallen sharply since a US ship seizure last week, and while Chevron continues to operate under authorization, most other flows are frozen by fear rather than law. The risk premium here isn't showing up in prices yet, but it's simmering beneath the surface. Zooming out, the broader energy picture reinforces the sense of oversupply. Goldman expects Brent crude to average in the mid-50s next year, with the market needing lower prices to rebalance. They do see a recovery later in the decade, but only after producers feel enough pain to slow investment. Natural gas tells a similar story, particularly liquefied natural gas, where expansion projects are colliding with softer demand expectations. That brings us to Australia, where Woodside Energy is facing a leadership transition at a delicate moment. The company is pushing ahead with massive liquefied natural gas investments, including the Louisiana project in the United States, at a time when analysts are increasingly worried about a global glut in the early 2030s. Finding buyers, locking in long-term contracts, and managing construction costs will define Woodside's next chapter. It's a reminder that capital discipline matters most right before the cycle turns. Let's shift gears into agriculture, where surplus is also the word of the day. India is staring at a sugar glut and has made it clear it intends to protect farmers by increasing exports and diverting more sugar into ethanol production. With production expected to exceed domestic consumption, New Delhi has already approved exports of 1.5 million tonnes this season. Global sugar prices are hovering near 5-year lows, and more Indian exports could push them even lower. At the same time, China's state stockpiler Sinograin has been auctioning imported soybeans, but demand is clearly cooling. Clearance rates and prices have declined in each successive auction this month. That tells us crushers are cautious, likely waiting for fresh US supplies and better margins. When the world's largest agricultural buyer slows even modestly, the ripple effects are felt everywhere, from Brazil to the US Midwest. Europe's grain outlook adds another layer. After a bumper harvest this year, forecasts suggest softer wheat and barley production next season as yields return closer to average. It's not a crisis, but it reinforces how quickly abundance can fade in agriculture, especially if weather fails to cooperate. Before we wrap up, I want to touch on trade policy, because it underpins all of this. The long-awaited European Union-Mercosur trade deal has been delayed again, this time due to resistance from Italy and France over agricultural imports. Farmers are protesting, highways are blocked, and political patience is wearing thin. This deal would reshape flows of beef, sugar and grains, but domestic politics remain a powerful brake. For commodity markets, uncertainty around trade rules is almost as disruptive as tariffs themselves. So what ties all of this together? Whether it's oil cargoes backing up in West Africa, sugar piling up in India, or soybeans struggling to clear auctions in China, the message is the same. Supply has run ahead of demand in multiple markets at once. Gold's strength, meanwhile, reflects a financial world bracing for volatility rather than growth. As we head into the new year, watch how producers respond. Will oil exporters cut back, or will they fight for market share? Will governments lean more heavily on trade barriers to protect farmers? And will investors continue to seek refuge in metals as a hedge against all this uncertainty? Those are the questions I'll be watching closely. That's it for today's episode of the Commodities Institute podcast. Thank you for spending part of your day with me. If you found this episode valuable, be sure to subscribe, share, and leave a review. I'm Emily Costa. We'll talk again soon.